Hi, good day all. It's my pleasure to be here with you again today. Today we'll be looking at a very interesting topic, inventory IAS2 and IAS8, accounting policies, changes in accounting estimates, and errors. In our previous class, we discussed accounting concept and convention. We talked about accounting concept and convention to be the principles, rules, axioms, and postulates to be followed in the preparation of financial statements. I will go ahead to look at IAS1 that talks about presentation and preparation of financial statements. It talks about the component of financial statement to be number one, the statement of financial position, formerly known as balance sheet. Number two, the statement of changes in equity, the statement of profit and loss and other comprehensive income, cash flow statement, notes to the account. We mentioned these five to be the core component of a financial statement. We also discussed what we mean by element of financial statement. We have five major elements of financial statement, which can be subdivided into two parts: the element of financial performance and the element of financial position. For the element of financial performance, we have two. The first one is income, the second one is expense. For the element of financial position, we have three. The first one is assets, followed by liabilities, and lastly is equity. Today, we'll be looking at another segment, which is two standards. The first one we'll be looking at is IAS2. IAS2 talks about accounting for inventory. Also, we'll be looking at IAS8. IAS8 talks about accounting policies, changes in accounting estimate, and errors. What's our learning objective? At the end of this session, students should be able to give examples of inventories, discuss the component of inventory costing, identify the costs that will not be included in the cost of inventory. Students should be able to identify the method used in measuring inventory. This represents the major learning objective for IAS2. For IAS8, students should be able to describe the concept of accounting policies, changes in accounting estimates, and errors. At the end of this lecture, students should be able to identify the accounting policies with example and also be able to identify the changes in accounting estimates with example. What is IAS2? What is the major requirement of IAS2? Why should we learn IAS2? For the purpose of ATSWA, Principles and Practice of Financial Accounting, is IAS2 a core topic that is required for this exam? The answer is yes. According to IAS2, we'll be looking at the accounting treatment that is required for inventory. We'll be looking at the measurement and also recognition of inventory. We have identified five major types or examples of inventory. The first one being merchandise products. Number two, production supplies, such as petroleum products, e.g. oil, gas, diesel, and so on and so forth. Number three, finished goods produced. Number four is work in progress produced, and number five is raw material. These are examples of inventories. But the commonly tested types of inventory for exam purpose is raw materials and finished goods. We'll be looking at accounting questions at the end of this slide to test our understanding of measurement, valuation, and the likes. In determining the cost of inventory, what are the cost components that is required? What are the cost components that we need to consider for us to be able to properly state the cost of inventory? Examples include, number one, purchase cost. Purchase cost in this case refers to the purchase price. Initial cost of purchase. Number two, delivery cost. For delivery cost, you can see that as carried cost. Cost of conversion, import duty, and non-refundable taxes. Transport, handling, and other costs directly attributed to the acquisition of finished goods, services, and raw materials. So in determining the cost of inventory, you will not just consider the purchase price alone. Every other cost that is incurred in order to bring the goods to a sellable condition will be added up together to form what we call cost of inventory. That's what initial recognition is talking about. Let me cite a very good example for you. If I purchase an item of inventory at a purchase price of 100,000, the cost of bringing it down to my office is 20,000. The total cost of that item is 120,000. Purchase price be 100,000. Cost of transporting it from the place of purchase to my warehouse is 20,000. The addition of the two is what? 120,000. For imported item, if I pay excise duty on it, landing cost on it, all of these could be added together to form my cost component. What are those costs that will not be included as part of inventory cost? The first on my list is storage cost. Storage cost, except if it relates to cost of storing raw material and work in progress before production is completed. Abnormal amount of wasted material or labor costs should not be included as part of inventory cost. Administrative overhead that was not incurred in bringing the inventory to its present location and sellable condition should not also form part of inventory cost. Advertisement costs, other selling expenses, and interest costs. These 6 elements of cost will not be included as part of inventory cost. For example, suppose you need to master these 6. The first one, storage cost. Number 2, abnormal amount of wasted material or labor. Administrative overheads, advertisement cost, other selling expense, and interest cost. There's a caveat on interest cost. For the interest cost incurred on qualifying capital assets, it will be capitalized as part of cost of inventory. Now, the next question is, what is qualifying capital asset? Or what is qualifying asset? The standard that talks about qualifying asset interest cost is IAS 23, borrowing cost. IAS 23 is outside the scope of my lecture for today, but it is important that I explain to you what interest cost means for you to be able to understand this principle, why interest cost that is incurred on qualifying assets should be capitalized. What is interest cost? The cost incurred on money borrowed to acquire or manufacture or construct inventory during the construction period is what we refer to as what? Interest cost. For instance, if you borrow a loan for the purpose of buying inventory, for the purpose of construction, the element you pay on that loan, the element of interest paid on that loan is what we call interest cost. So now, if the interest cost is on qualifying asset, it will form part of inventory cost. But if it's not, you will expense it. In line with IAS2, we have 2 major methods of measuring inventory. The first method is called weighted average, WAP. The second method is called first in, first out. Part of the changes in IAS2, last in, first out is also part of basis or method of measuring cost of inventory, but now it has streamlined to just 2. Weighted average method and first in, first out method. Now, what is weighted average method? By weighted average method, we are considering two major things. The value at hand in terms of quantity. The value at hand in terms of value itself. It's what we talk when we're talking about what? Weighted average method. How do we define it? How do we calculate it? Now, in practice, we can either consider it on a periodic basis or on a perpetual basis, but depending on the inventory system of the reporting period. So the formula we use for the purpose of your exam is to say the value in hand all over quantity in hand. The value in hand being the monetary value, the valuation of that inventory. The quantity in hand being the last quantity to date. That is what you are going to use to determine the weighted average price. Now, let me start a scenario. The value of inventory at hand is 100. Let's say 100,000 naira. And the quantity of inventory at hand is 10,000. So to get my weighted average is to say 100 divided by 10,000. 100,000 value divided by 10,000 in quantity. Whatever that is left, which is 10, is what we refer to as weighted average price. So 10 naira is my weighted average price. So in getting the value for weighted average price, you will consider the value of inventory at hand and the quantity at hand. Your value divided by your quantity will give you the weighted average price. First in, first out method. First in, first out method is one of the bases with which you measure inventory by considering the item that come into the store first, meaning that the items that were purchased or produced first are sold out first. Items that are purchased or produced first are sold out first. That's what we call first in, first out. As an advanced way to measure inventory, we need to look at cost of that inventory and also NRV. NRV means net realizable amount, net realizable value. I beg your pardon. In line with IAS2, how do we measure inventory? At what value should inventory be measured? Inventory will be measured at the lower of cost and net realizable value. Inventory should be measured at the lower of cost and net realizable value. How do I mean? You need to compute your costs. Know your figure. You need to compute your NRV. Know your figure. Whichever that is lower is what we are going to pick as the value of inventory. Why are you picking the lower or the lowest? The reason being that the value of inventory should not be overstated in the book. As an accountant, it must not be overstated in the book because it has impact on profit, it has impact on assets. So for convention of conservatism purpose, that's prudency convention, for that purpose, you need to consider whichever is lower. Let's divide net realizable value in the ordinary course of business, less estimated cost of completion and the estimated cost necessary to make the sales. Now, this may or may not be the same as fair value of the inventory less cost to sell. But for exam purpose, most of the time, net realizable value will be calculated by saying your fair value less cost to sell, or your selling value less cost incurred to sell, less selling expenses. Let's take a look at a very simple format to do that. Calculation of net realizable value. Estimated selling price in the ordinary course of the business. This is it. That's the sales value. less additional cost that will be incurred to complete the sales, that's the cost to sell, less selling cost that will be incurred in order to enable us to, in order to enable the sales to take place. These two, we can also see it as cost to sell, and less other cost that will be incurred for the purpose of sales. This minus this minus this minus this give you what? Your net realizable value. In a simple term, for example, your net realizable value would be the fair value given in the question minus cost to sell. What are the factors to be considered when trying to value at a net realizable value? But before then, there are some reasons that will make your NR be lower than your cost. There are some factors that constitute the reasons why your net realizable value will be lower than your cost. Physical damage is one thing. So when the condition of asset is not okay, it has been destroyed, the value of that asset will not be the same. Number two, an increase in cost or a fall in selling price will make the net realizable value to be lower than the cost. Obsolescence of products. When a product is out of date, it will command the same selling price as the product in bulk. A decision as part of the company marketing strategy to manufacture and sell at a loss. This is a common marketing strategy in Nigeria. They will sell at a lower price so as to increase or encourage the sales. By so doing, people will consume more, but the entity might run at a loss. Error in production or purchasing. Error in production or purchasing may be by your scrap product. Thereby, you cannot sell scrap products at the same price you are going to sell a very good product. Let's take a look at some examples. At the end of the reporting period, the closing inventory of XYZ Limited cost $3.8 million, was estimated to have a fair value of $4.3 million with associated cost to sale of $400,000. That is example one. Example two. At the end of the reporting period, the closing inventory of XYZ Limited cost $3.8 million, was estimated to have a fair value of $4.3 million with associated cost to sell of $400,000. What is the closing inventory used in preparing the statement of financial position? Now, if you look at example one and example two, we have it to be the same. So I will need to do a quick update. Let's make this to be 4.8. Let's make this to be 4.1. Yeah. Let's make it to be 4.1. So let's consider this to be 200. So let me take it again. At the end of the reporting period, the closing inventory of XYZ Limited, which cost $3.8 million, was estimated to have a fair value of $4.3 million with associated cost to sell of $400,000. At the end of the reporting period, this for example two, the closing inventory of XYZ Limited cost $4.8 million, was estimated to have a fair value of $4.1 million with associated cost to sell of $200,000. What is the closing inventory? What is the closing inventory value to be used when preparing the statement of financial position? Let me call this question one. XYZ Limited. This question borders on measurement of inventory. Inventory is measured at the lower of cost and neutralizable value. For question 1, the cost is given as $3.8 million. Cost. $3.8 million. Now, I need to calculate my NRV because NRV is not given. I need to calculate my NRV because NRV is not given. So, but I have fair value in the question and I have cost to sell. Let me call this cost to sell, CTS. So from the question, my fair value is given at $4.3 million, right? $4.3 million. And my cost to sell is given as $400,000. Do not forget to get my NRV, it will be fair value minus cost to sell. My NRV value is what? 3.9 million. Let me put it like this, less cost to sell. So, according to the question, determine the value of inventory. And to determine the value of inventory to be recognized in your statement of financial position, you need to know the cost, you need to know the NRV, then pick the lower of the two. So this equals this. So let me put a double bracket. Let me also put a double bracket. So we have our cost to be 3.8 million, and we have our NRV to be 3.9 million. The value of cost to be recognized in the statement of financial position is what? Is 3.8 million. The cost is lower. The value to be recognized is 3.8 million. Why? Because this 3.8 million is lower than 3.9 million. That marks the right answer for example 1. Let's do for example 2. Same X, Y, Z. Following the same template, the cost value will be given. NRV not given. I'll put question mark. From the question, what is my cost? 4.8 million. 4.8. I have this to be 4.8 million. NRV is not given, but I have fair value and I have cost to sell. Less. Let me put it cost to sell. So from the question, my fair value was estimated to be 4.1 million. 4.1 million. Cost to sell is $200,000. Fair value less cost to sell will give me what? NRV. You give me NRV. Now, I cannot say my NRV equals this. The value to be recognized in the statement of financial position is the lower of cost and net realizable value. From this, cost being $4.8 million, NRV being $3.9 million. The lower is NRV. What I'm taking to balance sheet or statement of financial position as my value of inventory is 3.9 million. Why? Because it is the lower of the two. Now let's take a look at example 3. The following relates to A. Adebipe Limited for the period ended 31st March 2004. Inventory A, B, C, and D. We have cost per unit, we have selling price per unit, we have marketing cost, we have other selling expenses per unit, we have unit of inventory held, you have unit in brackets required. Determine the value of inventory, determine the value of closing inventory to be used for financial statement purpose. If you notice, example 1 based on measurement, example 2 based on measurement, example 3 is a very example that we need to write this exam. And this is actually coming from one of the past questions. What did I change? Just the name. Every other thing remains the same. So determine the value of closing inventory. Let me clean this. Question 3, determination. Of closing inventories. Determination of closing inventory. Don't forget to determine closing inventory. You need to determine the closing inventory value. Let me put the closing inventory value. You need to know the cost. You need to know the NRV. Whichever that is lower is what we are picking as the inventory value. So to start with, let me say calculation of cost. I want to determine the cost. I want to determine the cost. So I have 3 products, right? 4 products, A, B, C, D. So for the cost of A, 70, for B, 80, 120, 90. So we have this as our cost price per unit. Cost per unit. Now, the next thing I need to do is to determine my NRV per unit. I need to determine my NRV per unit. To determine my NRV, I need selling price less selling expenses or less cost to sell. So to determine my NRV, I have selling price per unit. I have my selling price. I have my selling my marketing costs and other selling expenses. Marketing costs and other selling expenses. I have my other selling expenses. Can I quickly do that? Yes. So what my selling price for A 130, for B 125, 140, 120. One 125, 140, 120. Now I have my marketing costs. I have my marketing cost 30, 40, 25, 20. Do not forget less marketing cost. Very important. Less. Marketing cost in this case is just like what I call cost to sell less other selling expense. Because before you can sell, you need to incur all of those costs, else you won't be able to sell. So that is what cost to sell is all about. So like I mentioned earlier, it's not all the time you should be expecting fair value. Sometimes they will give you a unit selling price. Sometimes they'll give you exact sales value. So there's no selling expenses, other selling expenses per unit for A and B, but we have for C and D 10 and 15. Nothing, 10 and 15. Now what do I do? This minus this minus this. This is my fair value. Control R. Good. So I've been able to compute my NRV per unit for the 4 products. For unit A, NRV is 100,000, 100, apologies. Unit B, for item B, I have 85. For item C, I have NRV of 105. For item F, I have 85. Now that I've been able to determine both cost and NRV, then the next thing is for me to now determine the value. Now to do the value, I will need the unit. That's quantity at hand. Units. I will need that. For the units, A, 500 units, 400 units, 800 units, and 600. Correct. Now, I want to determine the value. I can come in to say inventory types. Inventories type. How many inventory types do we have? A, B, C, and D. We have these to be our what? Inventory types. Now, for A, we have cost price should be 70 naira per unit. We have NRV to be 100 naira per unit. Don't forget, inventory is measured at lower of cost and net realizable value. When you compare 70 to 100, which one is lower? 70. Then to get your value, you say the lower, which is 70, times quantity. That's for A. For B, cost per unit is 80. NRV per unit is 85. To measure inventory, we compare and pick the lower of cost and net realizable value. Which is the lower here? 80. 80 is price, and what is the quantity? 400. To get the value, 80 times 400. That will give us the value. 80 times 400. This is the value. For item of inventory C, the cost per unit is 120. The NRV per unit is 105. Whichever that is lower is what we are picking, right? 120 is bigger than 105. So NRV is the lower. Then to get the value, I will say NRV times quantity. And lastly, the cost per unit is 90. The NRV per unit is 85. Which one is lower? 85. To get the value, 85 times quantity. The value of inventory to be reported in the statement of financial position is 202,000. This topic is very interesting and it is examinable. This question is one of the past questions that have been asked, and here we have the solution. To go over it again, the question is asking us to compute the closing inventory to be used for financial statement preparation. We are giving the cost per unit, and we are giving the selling price per unit, we are giving marketing cost per unit, and we are giving other selling expenses per unit. We are also giving unit of quantity to date, and we are asked to determine the value. And in order to determine the value of inventory, you need to compare the cost and the net realizable value. Whichever that is lower is what we are picking. From the question, we have 4 products or 4 items, A, B, C, and D, and we have their corresponding price, 70 naira per unit, 80 naira per unit, 120 per unit, and 90 per unit. We have our NRV given directly. I mean, selling price information given directly in the question. Selling price information and the cost to sell information will be used in determining our NRV. So we have the selling price to be 120 for A, 105 for B, 140 for C, and 120 for D. Now we have other costs that will be incurred in order to sell those items. Don't forget, we call them costs to sell. And in arriving at your NRV, you will take out cost to sell from your actual selling price or from your actual fair value. In this case, we have selling price per unit. In doing that, we have NRV to be 100 for A, 85 for B, 105 for C, and 85 for D. Don't forget the lower of these two values will be used in computing our inventory value. 70 is lower than 100. That's why we are picking the cost unit for A. 70 times 500 gave me 35,000. I compared value of cost of B to the value I have in NRB. Which one is lower? 80 is lower compared to 85. 80 times unit quantity, I have 32. For C, I have a cost unit of 120. I have an NRB of 105. 105 is lower than 105 times 800. I have 84. And lastly, for D, the cost per unit is given to be 90 and the NRB is calculated to be 85. 85 is lower, right? Yes. Then to get the value, 85 times 600. Altogether, the total value of inventory to be recognized in my book is 202,000. Thank you for your audience. And this marks the end of inventory valuation or inventory accounting according to IAS2. Now, what are the major requirements under IAS2? For example purpose, you need to take note of this. The following are some of the disclosures required of IAS2 inventories. Number one, the accounting policy adopted in measuring inventory must be stated. That is inventory valuation method. Be it first in, first out, or weighted average, must state it. The amount of inventory recognized as an expense during the year. That is, what are the total amount of inventory that is eating up to cost of sales should be recognized. The current amount of cost of inventory carried at fair value less cost to sell or NRB. That is, the value of NRB should be what? Stated. The current amount of inventory pledged as security for liability should be stated. Yes, in practice, in order to secure loan or some form of liability, you can also pledge your inventory. That is, put your inventory as security. Do we have any inventory that has been lent or that has been used as a backup for a cash? Please disclose. That's what they are saying there. The amount of any write down of inventory recognized as expense in the profit or loss account should be stated. The amount of any reversal of write down that is recognized as an income or that is as a decrease in inventory expenses during the year should also be stated. The circumstances or events that led to reversal of a write down of inventory should also be disclosed. So these are 7 major identified requirements that is expected for disclosure according to IAS2. For exam subject matter, it is important you learn this by heart because one of the questions can come in to say, identify or enumerate or list or explain 5 disclosure requirements in accordance with IAS2. Now we have what we call disclosure requirements. We've been able to discuss successfully IAS2 provision in summary and what is examinable at this level. Thank you and God bless. Now I'll move to the next subtopic, which is IAS 8, accounting policies, changes in accounting estimate and error. This topic is wide, but for the purpose of this lecture, ATSWA financial account, we're going to look at the theoretical part of IAS 8 and we also look at the circumstances whereby changes in accounting policy, changes in accounting error and estimate. If it happens, how do we correct it? At least we are going to look at that in brief, but in your financial reporting, at skill level, we'll be going into full details of this. But for the purpose of our exam, and we need to be straight and direct as possible, this is what you have. Now, let's take a look at some terms under IAS 8. We have accounting policies, we have accounting estimates, we have accounting errors, we have prior period errors, retrospective application, and prospective application. We have 6 of them that we'll look at. We have 6 of them that we'll look at. Accounting policies. Accounting policies refers to as accounting principles, specific principles, basis, convention, rules, and practices adopted by an entity in preparing and presenting its financial statement. We call under accounting concept and convention, we also discuss accounting policies to the totality of approach, rules, and practices adopted by the preparer while preparing the what? Financial statement. I will give you a very good example of taxation policy, inventory policy, depreciation policy, and so on and so forth. Accounting estimates. This is an approximation in a financial statement of the amount to be recognized for which there is no precise means of measurement. A very good example of accounting estimate is provision for doubtful debt allowance. What are accounting errors? Accounting errors refers to as any form of mistake, any mistake on its financial statement or other accounting measurement. An error is a non-fraudulent discrepancy in the financial statement. We all point to error, right? So accounting error in preparing the financial statement, if you make a mistake that regarding accounting measurement or expression of figures, we can also refer it to as accounting error. Error is different from fraud. So that is why we call it an error is a non-fraudulent discrepancy in the financial statement. But as accountant, we need to be careful to ensure that no error is identified during the preparation of financial statement. Prior period errors. What is prior period? Prior period means previous year. Prior period errors, previous year. Error made from the previous year. Prior period error. Error made from the what? The previous year account or from the previous year record. These are omissions from the financial statement and all misstatement in the financial statement from one or more prior period arising from a failure to use or misuse of reliable information. That is, error that occur in the previous period due to failure to use or misuse reliable information. Let me give you a very good scenario of accounting error. If you are to report sales, the actual figure of sales is 2 billion based on the record, but unfortunately, what you record is 180 billion. The 20 billion in the current year audit, we then discovered that last year we did not fully state our revenue, thereby understating the figure of revenue. That is an error. It is non-fraudulent act. It's not intentional. It's not intentional. You didn't adequately use the information given to you, right? So that's what we call an error. Now, when error is made, we have ways of doing some correction. Then we'll be looking at retrospective application. From the word retrospective application. So basically, this is talking about going back to prior periods to adjust the transaction, to properly state, to properly correct the mistakes or errors that were made in that period. This is the application of new accounting policy to transactions and event of period before the policy was made, as if the policy had always been applied. So let's say there's a changes in accounting policy in this year, 2021. So to correct it, you need to go back to prior period to do the adjustment. From the prior period, you consider the adjustment. then down to the current time. Doing so, what we will refer to that is what we call retrospective adjustment. Going back, going into power period to correct whatever accounting policy or misstatement that have been made. For this level, I believe this explanation suffices. Prospective application from the word prospective. Now and going forward. This is the application of a new accounting policy to transaction and event occurring from the period when the policy was made. That is, the new policy will be applied from the period it was made, but the financial statement of previous period will not be affected. That is, will not be restated. So that's why I said now and going forward. So the correction will be made from now. The policy will be applied from now and going forward. You will not go back to the period of the past to correct it or to apply the policy. No, you start from now and you continue. Now let's quickly look at examples of accounting policies. Method of valuing inventory is a very good example of accounting policy. Don't forget, we just discussed IAS2, where we talk about two major bases or methods of valuing inventory: the first in first out method and the weighted average cost method. Another good example of accounting policy is property, plant, and equipment, PPE. I talked about that. So we have two methods of valuing PPE. We have the cost model and we have the evaluation model. Another example of accounting policy, again, is the method of value investment property. That is, whether at cost value model or fair value model. Method of depreciating on current assets. This, we have a lot of method of depreciation, but the two commonly used is the straight line method and the reducing balance method. Lastly, method of measuring financial assets. Here we're talking about IFRS 9, whether at fair value or at amortized cost. These are very good examples of accounting policies. So as an accountant, you need to know which policy your organization use, and you must be consistent in its usage. Changes in accounting policies. Now, at what point should we change our accounting policies? At what point should we change our accounting policy? That's a very good question. If the changes is required by IFRS, we can go ahead to change our accounting policy. If the changes is required by statute or law, we can go ahead to change our accounting policy. If the changes will result in a more appropriate presentation of the financial statement, we should go ahead to change it. These are the only three cases where we can change our accounting policy. One, when IFRS permits. Two, when it is required by law. And three, if the changes will be more appropriate for the presentation of financial statement. It's important I mention that two of these methods or the following will not be considered as a change in accounting policy. Number one, adopting an accounting policy for a new type of transaction or event not dealt with previously by the entity is not a change in accounting policy. You know, as business evolves, new things come, new transactions occur, and we need to put them to action. We need to disclose them in the financial statement. We need to adopt a policy for its usage. This is not a change in accounting policy. Adopting a new accounting policy for transaction or event which has not occurred in the past or which was not material. It's related. So let's look at the real thing that we can call changes in accounting policy. A change from FIFO to weighted average cost method is a very good example of change in accounting policy. A change in legislation that affects the measurement and recognition of an asset is a change in accounting policy. A change in existing standard, for instance, An introduction of a new standard that brought about a change in the current practice is a change in accounting policy. So a change in revenue recognition practices is a change in accounting policy. A change from the use of cost model in measuring investment property to fair value model is a change in accounting policy. The same thing applies to the depreciation. We are using state line method, and for one reason or the other, we change to reducing balance method, or we change to what's it called, to fair value model. Is a very good example of a change in accounting policy. Lastly, a change in presentation, such as depreciation transfer from cost of sales to expenses, is a change in accounting policies. Now, when we say changes in accounting for treatment or changes in accounting policy, what do you mean? I mean, how do we account for it? How do we account for changes in accounting policy? Remember, I talked about retrospective adjustment earlier. I talked about prospective adjustment earlier. So for changes in accounting policy, it is applied retrospectively, except it is all impracticable. What do you mean by impracticable? That is, the net cumulative financial effect arising from the changes in accounting policy should be adjusted retrospectively to opening balance retaining, except if it is impossible to do so. So going back to the books to do correction, if it's impossible to do so, then we might not adopt retrospective adjustment. But ordinarily, a change in accounting policy is correctly adjusted by using a retrospective approach. That is, you adjust it through the opening balance retainings. We talked about accounting estimates, right? What are the examples of accounting estimates? We have close to 5 examples that we can identify from the definition given by the standards. The first one we'll be looking at is provision of doubtful debts or allowances for receivables. A very good example of accounting. All this cannot be calculated with precision, so that's why. Useful life of depreciable asset or depreciation rate is an example of the accounting estimate. Provision for obsolescence of inventory is an example of accounting estimate, because we cannot, precisely calculate it. They are based on precision. Provision for warranty obligation is an example of accounting estimate. Provision for lawsuits provision for loss from a lawsuit is a very good example of accounting estimate. This we'll look at it more when we get to IAS 37. Also, fair value of financial liability is a very good example of accounting estimate. Don't forget, estimates are for approximation in accounting, and we cannot absolutely precise a figure for the until the final calculation. A change in an accounting estimate is a revision to the previous estimate as a result of new events, changes in condition, more experience, additional information, or subsequent development that has to come to light. Don't forget, accounting estimate has to do with what? Figures that we cannot absolutely determine by precision. So what are the examples of accounting estimate? Number one, a change in the percentage of allowance for receivable from one percentage to the other is a very good example of accounting estimate. A changes in depreciation rate, either upward or downward review of rate, is an example of accounting estimate. A changes in existing provision is an example of accounting estimate. A change in the pattern of depreciating asset due to a change in pattern of consumption. How do we treat changes in accounting estimate according to IAS 8? Don't forget, accounting policy correction retrospectively, retrospective adjustment. Accounting estimate, it is corrected prospectively. That is, you apply it prospectively from now going forward. According to IAS 8, the financial effect of a change in accounting estimate should be applied prospectively. That is, the financial effect of a change in estimate should be included or considered in the statement of profit or loss for the current period, while the affected asset or liability will be adjusted. Note, the financial statement of previous period will not be affected as a result of the change in accounting estimate. So the major difference between retrospective adjustment or prospective adjustment is, for retrospective, you go back, you adjust through what open balance retained earnings. But for prospective, the changes, the correction will occur from the year it was identified and going forward. Lastly, let's talk about power period error, that accounting error. Don't forget, we said accounting error that mistake made in the preparation of financial statement. There are mistakes made as a result of no or that we have misused information. So let's look at some mistakes that is common and that can be identified as accounting estimate. Number one, mathematical mistakes, incorrect or wrong application of accounting policies, misinterpretation of fact, and oversight of errors, oversight of fraud. Now, how do we correct power period error? Don't forget again. Number one, accounting policy, you apply it retrospectively. Accounting estimate, you apply it, you correct it prospectively, right? And for accounting error, it is retrospectively. Through what? Opening balance retained earnings, except if it is impracticable, that is, it is impossible to do so. Then you can now adopt a prospective approach. Now, for current period error should be corrected in the period the financial statement is prepared. That is, current period error should be corrected in the current period where the financial statement is prepared, as if the error was never occurred. So it's supposed to be what? Corrected in that period where it occurred, or when the financial statement is being prepared. Thank you, and God bless.